$100 invested in U.S. large-cap stocks at the beginning of 1928 would have grown to roughly $1.16 million by the end of 2025. That result raises a practical question. For most people, where should long-term money actually go? The same $100 would have grown to about $21,000 based on the historical gold price series, $7,753 in 10-year U.S. Treasury bonds, and $2,578 in 3-month Treasury bills. These figures come from the long-run U.S. asset return database maintained by New York University professor Aswat Damodaran. Over those 98 years, U.S. large-cap stocks returned about 10% a year, with dividends reinvested. The historical price of gold rose at an annual rate of about 5.6%. 10-year Treasury bonds returned about 4.5%. Treasury bills returned about 3.4%. A difference of only a few percentage points may look small. Compounded over many decades, it becomes a difference of tens and sometimes hundreds of times in ending wealth. These are nominal figures. They are before taxes and they are not adjusted for inflation. But the long-term gap between the asset classes is unmistakable. This video makes a simple case. For most people, stocks are the best long-term investment among the major investment tools broadly available to them. The evidence comes from almost a century of modern U.S. data, 2 centuries of historical research, and long-term records from markets around the world. Damodaran's database is only the first piece of evidence. Jeremy Siegel extended the U.S. market record back to 1802. Across 3 widely separated historical periods, he found that real equity returns remained close to 6% a year. Over the long run, they exceeded the returns from fixed-income assets, gold, and commodities. The earliest 19th century figures had to be reconstructed from historical records, and some of the exact estimates remain debated. That is why the conclusion also needs support from modern data and international evidence. Elroy Dimson, Paul Marsh, and Mike Stanton built a global investment returns database covering 35 markets. 21 of those countries have continuous investment records beginning in 1900. Across all 21 countries, equities outperformed both long-term government bonds and treasury bills over the full period. Damodaran examined almost a century of modern U.S. data. Siegel extended the American record across 2 centuries. Dimson, Marsh, and Stanton broadened the evidence across countries. Across different researchers, time periods, and countries, the conclusion is remarkably consistent. Diversified ownership of businesses has delivered much higher long-term returns than cash and government bonds. The next question is why. Economic growth comes from capital accumulation, technological progress, and gains in productivity. Businesses organize those forces and convert part of the added value into profit. A share of stock is an ownership claim on a business. Shareholders hold the residual claim on the company's profits and future cash flows. A bondholder's interest and principal payments are largely fixed by contract. Equity owners participate in the upside when business profits grow. When a company can reinvest retained earnings at attractive rates of return, today's profits can create tomorrow's profits. That is compounding inside the business. It is the most important source of long-term equity returns. Higher long-term returns come with greater uncertainty. A company can lose its competitive position. Its products can be displaced. Management can allocate capital badly. An individual stock can even become worthless. The market as a whole can also suffer severe drawdowns and long periods of disappointing returns. The prospect of returns above cash and government bonds is compensation for accepting business risk and price volatility. That long-term advantage does not arrive on a schedule. Stocks can trail cash or bonds for years, and sometimes for an entire decade. The equity premium only matters if an investor can remain invested long enough to capture it. If the money may be needed during a severe drawdown, the expected return on paper offers little protection. The investor may be forced to sell while prices are depressed. A long-time horizon is part of the investment strategy. Good investing means making time your ally. For most individual investors, stocks have another major advantage. They are accessible. Real estate often requires substantial capital. Operating a private business requires specialized skill. Private equity is illiquid, less transparent, and largely unavailable to most people. Many other potentially high-return assets are simply out of reach for most people. Public equity markets offer a rare combination: low entry barriers, deep liquidity, extensive disclosure, and the ability to build a diversified portfolio at very low cost. Through a low-cost, broad market index fund, an investor can own hundreds or even thousands of businesses with a modest amount of capital. There is no need to identify tomorrow's biggest winners in advance. Broad indexes evolve as market capitalizations and constituent lists change. Growing companies gain weight. Declining companies lose weight. Some are eventually removed. This process cannot prevent losses from market drawdowns or business failure. It can, however, prevent a portfolio from remaining permanently tied to yesterday's industrial structure. As a result, individual investors can own a continuously updated collection of businesses at very low cost. They can participate in the wealth created by the corporate sector over time. That is the crucial distinction between public equities and many other high-return assets. Stocks combine a strong long-term return record with broad, low-cost access for individual investors. Of course, this conclusion depends on several conditions. The money must be genuinely long-term capital. The investor must be able to tolerate severe market volatility. The portfolio must be diversified. No matter how good a company may be, never put all your eggs in one basket. Costs, taxes, and unnecessary trading must be kept under control. Investors should also avoid leverage that could force them to sell at the worst possible time. For most investors, a low-cost, broad market index fund is the sensible default. Once you move from owning the market to choosing individual companies, the burden of proof becomes much higher. Two more questions matter. Has the company's growth translated into higher earnings, cash flow, and intrinsic value per share? And has the purchase price already discounted too much of the future growth? Growth in the size of a company does not automatically benefit its existing shareholders. Even a great business can become a mediocre investment when the starting price is too high. Those questions do not change the long-term case for equities as an asset class. Almost a century of modern U.S. data, 2 centuries of historical research, and international evidence across many countries all point in the same direction. Business ownership has delivered substantially higher long-term returns than cash and government bonds. Stocks represent ownership in productive enterprises. They allow shareholders to participate in profit growth and the compounding created by reinvestment. Public markets are liquid, transparent, and accessible. They allow individual investors to own a diversified and continuously evolving collection of businesses through a low-cost, broad market index. For investors with long-term capital, the ability to withstand volatility, and a diversified approach, equities should form the foundation of a long-term wealth-building portfolio. For most people, stocks are the best long-term investment.